Welcome to FUELSCast, a podcast by Mansfield Energy, your go-to source for the latest market updates in the oil and gas industry. Stay informed and stay ahead with insights that fuel your success. Today on FUELSCast, we have two special guests from Mansfield joining us. Andy Milton, Senior Vice President of Supply and Distribution, and Matt Smith, Director of Supply. Andy brings over 25 years of industry experience from beginning as a supply manager at Racetrack to now leading Mansfield's supply team. Matt has nearly 12 years of experience at Mansfield, having started in carrier relations and then working his way up in the supply department. Andy and Matt bring expert knowledge to today's conversation on market updates in the energy industry. They closely monitor our market daily and lead our supply department, ensuring they stay at the forefront of industry trends and developments. Welcome to the very first episode of FUELSCast. How does it feel to be the first ever guest speaker?
Feels great. I'm enjoying following him. It's an honor.
Following in his footsteps.
Yeah, always.
As it should be, Matt.
Well, we're here to talk about the fuel market. So I think we should start with a hot button question. I think everyone's concerned about the upcoming U.S. election. So given that upcoming election, what are some things that could shift for the energy industry given a shift in political White House?
There's a change coming, you're saying, huh?
There's a change coming.
We're just going to jump right in the deep end, aren't we?
Yeah. I like the hard question first.
Yeah.
You want me to take it?
I'll go first. I think my answer will be pretty generic. So I think obviously if we keep a Democratic House, I think we'll continue experiencing a lot of what we have today. Right? If we have a Republican House, if we look back when Trump was elected, crude oil prices, they dropped when Trump was elected. In fact, OPEC had to do a production cut 30 days after he came into office because they saw prices falling so much. Obviously, they had a personal incentive to raise prices. So I think all of this hinges on what is demand, what's the economy doing globally. That seems to be the Achilles heel to whether the market's going to run bull, run bear. But that's my prediction. Andy, what do you think?
I think it's good. We'll do a couple things. I would say don't underestimate the challenge that the industry has now that we've got all this aggregated business now that's in Texas, where people have bought up companies, aggregated companies. They're large groups now that are in charge of production in Texas. So I think OPEC is going to have a hard time pushing them around to a degree, different than the 2016 situation. I would say certainly if it's a Harris ticket, I think California probably continued regulation, maybe a little bit harsher than what we've had. But you've also got to think sometimes when there's harsher regulations, there's less supply, there's actually higher prices and more volatility. And I think there's people in the marketplace that kind of like that as well. I would say if you've got a Trump ticket, then certainly it's drill, baby, drill, what you heard at the RNC. Back to my point, I think it's also the same point where those aggregated companies now, they're not going to be as wildcatty as they were previously, just going out and just drilling everywhere. I think they're going to be a little more reserved and controlled. So neither situation, I think it poses a great deal of volatility. But I do think your point about OPEC, I think that is probably the thing that might surprise everyone. Sure. Because I think everyone's discounting that OPEC is just going to sit on a strategy and stay with it. They could 100% just do a 180 on their strategy. Yeah.
Well, they've already said they're going to keep production cuts low through 2025, but
for now,
that's the answer today.
Yes. We'll see.
Well, I think the other question at the top of everyone's minds, obviously, is what are the fuel prices going to look like given a shift in the White House? They're going to go up, they're going to go down, kind of stay where they're at.
You're assuming there's a shift. There might not be a shift.
There may not be a shift at all. But
yeah, I would say, again, coming back to the point, if it's a Trump ticket that wins, you might see lower prices and lower volatility, only because he will maybe open up some regulations. I don't expect it to be huge. I don't expect it to be some major discount to the mid 70s we're at today. And the opposite, I wouldn't expect some big price rise either if it's a Harris ticket winning.
Well, the only key on the Harris ticket, I would say, is what is demand going to do? Because if you look at the tenure of the current Democratic office, a lot of that has been higher prices now up until the last about 3 to 6 months when demand has kind of offset some of the production that's come online. So does demand come back or do we fall more? I think.
And it's not just U.S. demand.
No.
You got to be looking at what China's doing and really global demand.
Yep.
I think another thing coming down the pipeline, we've seen a lot of energy transition policies coming down, LCFS coming through. If there's a shift or not a shift, do you expect more to come down? Stay where we're at? What are you thinking?
I would absolutely think more states come through with LCFS program like things. I don't know if the federal government would get there, but maybe they could do something. But certainly maybe some more Northeast states and maybe some mid-Atlantic states potentially.
Yeah, I agree. I think we talked about this earlier, the LCFS program and the kind of boutique diesel fuel that's coming with this renewable aspect. It reminds me a lot of the boutique gasoline that is nationwide, where you have RFG mandates, CBOB mandates, low RVP. Phoenix has a lower RVP mandate than what's surrounding. So you start having a few more hurdles that these refiners have to meet spec to get to, which often can cause price volatility.
And you think about Illinois' constant change now with the biodiesel and tax incentive percentage. You get more states like that with Minnesota's, now with city of Portland having their own. So now you get to this local, even city level changes in specs and regulations. That makes it really, really tough.
I was going to mention it's becoming not just a federal, it's becoming a state and a local, and there's confusion between the local and the state and federal of what do they follow, how strict do they have to follow it, but it's a mandate. So, yeah. We'll shift gears into crude oil production. What are we seeing right now with crude production in the U.S., globally? What's it looking like?
Certainly, the U.S. is hitting all-time highs again. We're at 13.3 million barrels per day. That is big numbers. And I would say for the audience, don't underestimate how massive that has been for our economy and keeping prices lower. Going back to my point about the aggregation kind of going on and everything else, maybe we can see a little bit higher, but I don't think it's going to be just a straight, mountain from here. I think it's going to at some point flatline. So.
I know Hurricane Beryl obviously just came through, took out parts of Texas. Houston was out of power for.
I could not imagine being in Houston and being out of power for a week in the middle of July. That would just be awful.
Miserable. It didn't really affect any production or anything like that with the refineries out there.
A little bit of the rigs kind of going down for temporary safety reasons, but nothing there. I think your point on global, I would say keep an eye on Canada and the fires in Canada and what that could do to production there. I think that would have something that might impact supply.
Yeah. One thing we covered in Fuels News just last week and even today was they're literal miles from the oil sands. So it's not far. It could take it out in a heartbeat. So it's something to be on the lookout for. OPEC's recent decision to extend cuts. I think that's another hot button issue coming down the pipeline. Do you expect them to extend them through another quarter?
I think if you're betting on what OPEC's going to do, you're going to lose money. I think they actually almost intend to keep the market on its toes. So that's my point about the big wild card, certainly after the presidential race, is there's no telling. I certainly want to make sure, I think they want to make sure they are
relevant.
Absolutely. That's a great term. That's a great term. Relevant, and basically the ones that are in charge of the maneuvering of the price and the production more so than anything else. But it's a really good term, relevant. Hey, that's super important.
Yeah. Yeah, because back to what you said, the independence that the U.S. is driven off of the crude oil. In the past, prior to that happening, OPEC would make a production cut and heating oil would jump 10, 15 cents. Now they make the same news and it goes up 50 points. They just don't.
Production's a big deal.
It's a big deal.
I think also on the international front, China's demand has been in the news a lot lately. Softening, weird economic data coming out of there. What are your thoughts around that?
Well, I don't know if you can trust any economic data coming out of China for various reasons, but certainly China doesn't want to have the economic slowdown, but they may have a problem they can't fix when it comes to population. And that's going to be an interesting challenge. Certainly there's a real estate housing dynamic there that is hard to really comprehend. But I think that's going to be something that drags the whole market down.
Yeah,
keeps everything oversupplied.
One of the world's largest economies showing demand destruction is is a big concern because they're going to do everything they can to not make it look that way.
Right.
Yeah, save face.
Yeah. You think that's going to trickle over to the U.S. or?
I think it already has. I think it's already helping to keep global prices a little bit lower and supply a little bit better than it has been.
A little bit more balanced.
Yeah.
What about pricing? You think crude oil pricing's gonna?
You come up with these really tough questions,
like
like political. What are prices going to happen? Oh wow! We've been super range bound for the last I don't know how many months, Matt. Just seems like most of this year. So after having 4 years of what I would consider the most volatile time ever, it's hard to imagine the market just sitting back and being more calm. But maybe that's the new thing for 2024 and 2025 is a little more calmness, barring any Russia, Ukraine, Middle East tensions, that type of stuff. I think that's gonna maybe kind of be what we should expect.
Yeah. What about the Strategic Petroleum Reserve? It's been not really in the news lately, but I know the Biden administration has not been refilling it. If there was a shift in the White House, do you expect it to fill back up, kind of stay where it's at?
Yeah. Well,
it's all a prediction.
So my guess is that that is all price driven, right? So look at when the SPR was used in the past. It's when prices were being felt at the pump by consumers, and it was almost a political effort to bring some temporary price relief, right? And then now the market switched. That occurred whenever it was most expensive to refuel. Now you're better off waiting. Now the market structure's changed. It's cheaper to refuel now. I don't think they have much to gain by using the SPR right now to bring any type of relief to flat prices. Unless
you get some kind of thing that causes it to spike, right? You got 4 months until election time. So it's possible, but I'm with you. Pretty unlikely.
Yeah. What about diesel? What are we seeing with diesel right now?
Yeah. So diesel, if you look back in the winter, right, we were still in a backwardated market. So you're losing 2 to 4 cents carrying diesel month over month. And then we didn't have much of a global cold winter, right? We go from 5-year lows in the US and 5-year lows in Europe on diesel, all the way up to 5-year averages because you didn't have a lot of consumption. Production stayed pretty similar. The demand started waning a bit. So inventory levels increased. That brought some fear and risk out of the market, in my opinion. And now we've seen the structure flip from I'm concerned, I'm raising my price now to I probably need to move it now type structure. So it's in the consumer's best interest, but the market is eased, but it all seems to be hinged on the lower demand that we've seen the last 3 to 6 months.
Right. You're definitely seeing the days of supply increase a little bit, right?
Absolutely.
And that's not an increase in production, more so the lower demand.
Correct.
Also, those that read the Fed Beige Book, I'm sure everyone reads every quarter the Fed Beige Book of 60 pages of economic data. But if you do, then certainly you'll see in there softer demand numbers in transportation, energy. But I think something we're feeling across the country, and certainly we can see it in our customers. Nothing dramatic, but just enough of a percentage that you can definitely see it.
Okay, let's backtrack a little bit. For those who may not know what days of supply means, let's explain that a little bit.
All right, so you can look at just supply, and you can look at just demand. They're going to each tell you something different, but I think when you combine them, it gives you the perspective of are you net increasing in inventory, net of demand, or are you decreasing days of supply or inventory, net of demand? And the last few years, we've seen a decrease. It's been a real struggle. It's been a supply crunch. And that indicator for us is, I think, the best way to kind of see where things are heading. And you can look at the last 3 years, Matt. It's been just a straight kind of move up a little bit. But again, not based on production, really just a little bit softer demand.
Yeah. And I would say different. I view it almost as what's the insurance that's in the market, right? Because refinery production is going to have hiccups. There's going to be weather-related events. There's going to be problems that the market experiences. And how quickly do you feel that in prices comes down to how much days of supply, how much reserve product do you have to kind of weather the storm. Mm-hmm. And that's why when we were at 5-year lows, we had some quite volatile diesel pricing, the last two heading into the winters, late fall, early winter. But again, then demand kind of got soft, inventory levels rose. So now you could have similar bumps in the road and probably not see prices move as drastically as they did before.
Yeah, and interesting though, thinking about that refining production, you've got Exxon had a nice production increase in Beaumont, was it January or February, whatever it was. And you got Lyondell that might close in Houston, which basically balances out. So net of those two things is kind of flat. The U.S. is not going to have a big increase in production. So if gasoline demand continues to struggle, maybe go down flat, and diesel demand goes up a little bit every year, just a little bit, just based on growth, it could be a little bit tighter on distillate in the next few years.
It could be,
depending on what's going on globally.
Especially if jet still runs.
Absolutely.
Because jet
100%.
demand has been very, very heavy of late. It's been the shining star of demand for this calendar year, for sure.
Good call out.
Is there a normal days of supply that we like to sit at? 30, 35?
I think that 35 to 40 mark is probably the norm. We're, I think, at 32, 33 today. Okay. During COVID, we got as high as 55, which was insane. And during the really crazy recent supply crunch the last few years, we got as low as 25, 26 days.
Yeah.
So I think that 35 to 40 would be more normal.
And that is what will be a 5-year average as well.
Yeah, there you go. Mm-hmm. Look at Matt with the stat.
There you
go.
Right. Matt with the stat. That's a
stat.
Brand yourself with that.
Tagline.
Mm-hmm. What about right now? We're considered in the summer driving season, but demand is down.
Down versus what people expected. Right. Because there's this expectation, certainly, that peak demand time, people are going to be driving like crazy, lower prices than maybe the last few years, because gasoline demand does tend to be a little more elastic with fuel price. But you're right, they're not there. It's just not picking up as much.
And is it because hurricane season's not near as bad as what they've predicted? Knock on wood. We're hoping there are no more hurricanes come through.
But we did just have, by the way, the earliest Cat 5 ever.
Which
freaks me out.
Right.
Which makes this whole beard
which
more gray.
Means, August or September could
yes, it does. Yes, it does.
Yep. And not to overlook, August and September statistically is the highest activity of the whole season. So the concerning part is still in front of us.
I'm glad you got this, Matt, because I'm going to take the next 2 months off. It's all you. It's all you.
Follow you to the Bahamas.
The Bahamas.
Yeah.
I think hurricanes still hit the Bahamas.
They do.
Yeah, I might go West Coast instead.
Let's talk gasoline now. Okay. Gasoline demand's also down, way down.
Mm-hmm. Absolutely.
I'll add that. Yeah. So, for example, my wife and we just bought her a new vehicle, right? So her old vehicle got 20 miles a gallon. The new one, same horsepower, gets 32. So I think as these new vehicles get on the road, these producers have more regulation to increase the miles per gallon. So I think just naturally there, if you don't have the offset of higher population, higher demand to offset that miles per gallon improvement, then you're going to see a net decrease.
And you're going to see a little bit more EVs in the market, although it definitely seems like more of a push to hybrid now, which I think makes a whole lot more sense for the American family in most cases than a full-on EV, which either one's going to save fuel mileage.
But where does that stand with RD being pushed, renewable diesel being pushed down the pipeline? I think that's the big push with some of the LCFS things coming down. So at what point are we going to see RD being put in on-road vehicles versus moving to an EV?
If you've got a consumer vehicle and you're in California, you're probably already loading RD today and you don't know it. I think the interesting convergence is the fact that when you break a barrel of crude down and you process it, you only get so much gas and so much other products. If gas demand continues to decline at a certain rate, and really that cliff starts to tilt fast, then what happens with the rest of the barrel? It's still going to come from somewhere. I think that's going to be the fascinating part. You might see this huge price spread blowout, even more than we've seen recently between gas and diesel. You might see us close down more refineries that aren't in great places and aren't advantaged. They don't have options to take it to market. Maybe even see distillate become a little bit of a challenge as those refineries do close in the U.S. Those old facilities that no one wants to put $1 billion of investment into.
Sure, or maybe they're landlocked. I think to your point, to where when they get production, maybe they have an advantage of the crude that they can run, but they're not located on the coast, so they can only push their refined products as far as the pipeline will go. And to compete with a coastal market, you have to drop your price.
And that seasonality of the demand on gasoline is huge. It really impacts the whole supply chain.
Yeah. Aren't there some bills coming through, though, that are mandating refineries update their infrastructure or else? Or did I
haven't seen that offhand, but certainly that would be interesting when you talk about trying to mandate certain things. Now, there's There's been cleaner regulations that the fuel that we're burning today is way cleaner than the fuel 20 years ago, gas and diesel from the sulfur content. But I'm not aware of any other regulations coming down. That doesn't mean there won't be, though.
Yeah, I feel like I read that somewhere. I'll have to.
But that's a good example of how a political position
100%.
can have steep implications in future prices.
Exactly.
Yes.
Yeah. What about E15? What's the adoption rate of that? There's a lot of discussions going on around E15.
You want this one now?
I'll tell you how this one's been fresh. So E15, it's so in the southeast. I'll at least put it this way. We've probably got 45 terminals, couple hundred suppliers. 4 of them offer E15. So it's not a widespread high demand product in the southeast. I think there's some regional aspects, the Midwest, where the infrastructure at the terminal can support it a little bit easier, may make it easier for the consumer to buy it without a premium at the wholesale pump. But the demand just doesn't seem like it's very high for it.
I would also say, I mean, we all have retail friends in the industry that they put all the E85 pumps, the E15, the E10, the non-ethanol, and you're like, I don't think the average consumer understands all that mess.
6 options.
Yeah, exactly. It's like, give me gasoline, you know? So I do think there's a challenge of educating the customer and the end user on that difference. The infrastructure costs money as well. To your point, man, there's logistics challenge as well. So another interesting thing you mentioned renewables earlier, and this is going to really impact the market going forward, is now we're taking ethanol, not putting it in the gasoline stream, we're actually reprocessing it to make renewable diesel and SAF, which is a whole new thing going on. So I think E15 is going to struggle a little bit. Might be pockets, like your point on logistics, where it makes sense, but it's an average consumer just doesn't really care. They just want gasoline,
Right.
whatever it is.
Yeah. We've already talked a little bit about renewables. What about RINs? I think there's some conversation. A lot of people don't even know what RINs is.
You want to tell everyone what a RIN is?
It's a renewable identification number.
It is. I can't remember. It's like 32, 38 digits.
32 digits long.
It basically just says where the product is made, what it was made from, who made it, and kind of just tracking of the product. But that has been a little volatile lately. It's come off quite a bit.
Yeah. And retiring them.
Certainly people need to, and there's occasionally news stories of people not retiring them as they should. Certainly compliance is important. That's why you should always tell your supplier how you're using the fuel to make sure that you as a consumer and the supplier stay compliant. But that's actually a really added cost to doing business.
Mm-hmm.
So your point about politically who wins, well, that's a cost of doing business that people have to kind of manage.
Yeah. I think it's a cost that we've had a lot of sustainability type customers, wondering what is the price parity. If they're buying RD, you got to ship it across the US from, certain markets, but then there's the added cost of the RINs and everything else tied to that. So does it make sense?
Well, the RINs will help the renewable diesel cost net, but it's the managing the compliance, manage everything. Then you've got this additional LCFS, low carbon fuel standard value, which has not been where people expected it to be when they made their projects. So now you've got this challenge of a lot of people aren't making money producing renewable diesel, but yet you've got this expectation of it being in the marketplace. Something we'll have to give.
And we've already seen a refinery or two change strategies.
Yeah, no, I think Vertex made it very public in their facility in Mobile, Alabama, that they were going to shut down their renewable diesel production.
Yeah.
Which is, I think, a shock to the market.
How many refineries right now do we have converted?
Converted? That's a good question. I'd say maybe 6 to 10 that have converted fully. And I think it's important to know when you do convert, it's not like you're just taking a crude tower and just going to make renewable diesel now with some kind of, animal oil feedstock or something. You're usually limited to what your production is going to be. So if you were a 200,000 barrel per day facility, now you're maybe making 50,000 barrels per day of whatever you're going to make. And you're not going to make gasoline, which freaks out people.
To me, that's key is whatever has become the norm to generate a price in a market. You're now going to take a smaller percentage, even though you're producing a product that's attractive to a customer and end user, you're able to make less from it. And that's going to, again, going back to that level of insurance and how to weather storms, I think that's going to introduce a lot of price volatility. Yeah.
And you do have a couple of facilities like the one you mentioned in Mobile so maybe there's a way to make a small amount of that special renewable diesel without messing up the entire facility. I could see maybe that being more of the norm going forward, as ways to kind of find a way to make another product without upsetting the entire facility.
Interesting. So overall, our market trends we're seeing this year, how is it stacking up to last year, or even the year before?
It's a snooze fest this year.
Snooze fest.
I got so used to volatility and craziness. This is what made it all gray. And now it's kind of a little more chill, which is kind of nice, not going to lie. And, but it does feel weird, right? We had so much chaos for so long between COVID and the hack in the Southeast, Winter Storm Uri, a couple of hurricanes in the mix, the Ukraine invasion, which then sparked the market going crazy. And
Europe going short diesel.
Fox News saying we're out of diesel across the entire country was not my fault, by the way. And now we're a lot calmer right now in the market.
Do you think the snooze is here to stay?
The snooze. I think right now, things are rather calm. Again, barring any additional Middle East tensions, OPEC changing strategy, another military invasion of one country or another. I think we could expect us to be range bound for a little while. Post-election, I think people will take different strategies on all things they do. I think OPEC may change their strategy. I think countries' view of military decisions may change as well. I think you have some economic situation as well coming. So I think for a few months, I'd expect calmness, hurricane probably being the one obvious thing that might come up. But outside of that, let's hope
knock on
wood and get some calmness for a little bit.
Yeah.
But again, I keep going back to the demand. Yes, the macro levels, but all of this calmness is come from an ease in demand. And so if we find a second wind or whatever it may be to resurge that again, we may see prices move pretty quickly.
And I think it's a fantastic point because job market has been super resilient.
Going on.
Shockingly, I think. So if that can continue to hold on, you're right. We get a little bit of recovery. I think globally, you're not going to put your money in China. You're not going to put it in Europe with all their stuff going on. So the U.S. is still a great place, still very healthy overall, all things considered. So yeah, maybe a little bit of just a slowdown and kind of ramp back up.
Sure. I mean, 2021 was crazy because the demand destruction that came during COVID, and then suddenly the world was back to normal and production and inventory levels, they were not there and ready for it. So prices moved and they moved fast. So
we don't have a surplus of production we can go back and lean on.
No. We're just slowly building inventory levels. That's it.
Yeah. Another thing is the rate cuts. So if those stay or if they go, if the feds do another one, what does that mean for our prices?
Yeah, if they actually do a rate cut, that would be big.
Yeah.
I certainly was on the bandwagon of higher for longer, but to what Matt's saying about the demand, I think it's enough that we might see a rate cut before the election. Let's just see.
They're predicting September, but
you
don't ever know.
I can see this time. We'll just again, if you want to read the beige book, there is enough data to say that there is a little bit of enough of a slowdown that maybe the Feds would consider a small cut this year.
Interesting. Any advice, I guess, for our listeners or the fuel buyers out there on what to watch for in the next few months as we head to the closeout of the year?
I think what I get amazed about is people looking at the prices today and they think they're high. I'm like, they're not high. Inflation is no joke. It's real. And I think what you thought of as high 10 years ago and what is today, I think you might be surprised that people just really took a step back and thought, maybe prices are actually quite low in the U.S. Maybe we're pretty lucky. The one thing we didn't talk about and didn't mention that might drive prices would be if we get a weaker dollar, then I think commodity values could potentially go up. And I think that's an interesting concern.
Mm-hmm. What would make the dollar go weaker?
Rate cuts. Right. So we're actively trying to do some stuff in the marketplace and maybe change things. I could see that. Maybe all of a sudden we get a commercial real estate debacle here in the U.S. Maybe what happens in China starts to spill over a little bit into the U.S. more.
So my point would be the past 2 years, as Andy mentioned, we've had a lot of volatility. So if you're a fuel buyer, I would strongly assume that you knew exactly what your plan was. And you had a strategy to meet your company's needs during that time. And kind of like Andy mentioned, it's a little bit of a snooze fest right now. But whether that lasts,
that's patent, by the way.
I'm sure it is. Whether that lasts another week or another year, I wouldn't get loose on my strategy, because all it takes is one political issue, one global issue, and we can quickly return to that volatility. And if you hit snooze during this time, then you could find yourself a little bit exposed.
I like that.
You heard it from the experts.
That wraps up this episode of FUELSCast. We hope you enjoyed our market update discussion with Andy and Matt. If you haven't already, make sure to hit that subscribe button so you never miss an episode. We'd love to hear from you. If you have any questions, comments, or ideas for future episodes, please send them our way at marketing@mansfieldoil.com.
Bigger reach, broader solutions, better advice. Now you can.